The three core paths and characteristics of the U.S. future economy are key to understanding the current market uncertainty. Each path stems from the core contradictions of the current U.S. economy, the interplay of lingering inflation risks, high interest rate pressures, soaring debt levels, and sluggish economic growth. First, let's examine a soft landing. This is the most desired outcome by the Federal Reserve, yet most people consider it unlikely to achieve. Its core definition does not mean the economy will return to a prosperous bull market, but rather that the economy will not experience a sharp downturn while inflation is controlled and continues to decline, with stable employment. Although U.S. inflation has eased recently, it has consistently struggled to reach the Federal Reserve's 2% target, which has become one of the core obstacles to a soft landing. In a soft landing scenario, interest rates will not drop sharply because the economy has not fallen into recession, and the Federal Reserve does not need to resort to aggressive easing to rescue the market. Instead, it is more likely to adopt a gradual interest rate cut strategy, meaning the market will remain in a relatively high interest rate environment for a long time. In this context, the economy will not see a significant recovery but will repair slowly. While corporate operational pressures will ease, they will not be completely eliminated, and household consumption will remain cautious, presenting an overall lukewarm state. The reason most people are skeptical about a soft landing lies in the fact that the current U.S. debt scale has reached an alarming snowballing level. High interest rates mean continuous increases in debt interest payments, which exert persistent pressure on government finances and corporate financing. Meanwhile, although the job market appears stable, there are hidden signs of declining job quality and layoffs in some industries. These potential risks could disrupt the balance of a soft landing. Next is a hard landing, a scenario where the economy fails to hold on and slides into recession. Its specific manifestations include large-scale corporate layoffs, a surge in small business closures, a significant cooling of consumer demand, negative economic growth, and a sharp drop in asset prices. While this situation sounds terrifying, it is essentially a turning point in the economic cycle, because the onset of recession will force the Federal Reserve to take decisive action, accelerating interest rate cuts and launching loose policies to stabilize the economy by injecting liquidity. From a historical perspective, the short-term pain brought by a hard landing often spurs opportunities for asset repricing. Asset values previously suppressed by high interest rates will recover rapidly under loose policies. Current U.S. economic data has shown signs of decline, with the job market gradually deteriorating and corporate investment willingness weakening, all laying the groundwork for a hard landing. Unlike the protracted nature of a soft landing, a hard landing is a choice of better short-term pain than long-term agony. Although it will trigger market panic and asset depreciation in the short term, it can quickly break the stalemate of high interest rates and low growth, allowing the economy to re-enter a recovery cycle. It is worth noting that a hard landing is not the end of the world but a process of market clearance. Companies lacking competitiveness and relying on low-cost financing will be eliminated, while high-quality assets will reveal their investment value after price corrections, laying the foundation for subsequent market rebounds. Finally, there is stagflation, regarded as the worst yet most likely scenario at present. Its core feature is the coexistence of sluggish economic growth and high inflation, forming a predicament where the economy is teetering on the brink while inflation remains persistently high. In this case, the Federal Reserve is caught in a dilemma. To stimulate the economy, it needs to cut interest rates and ease policies, but this will further push up inflation and lead to loss of price control. To curb inflation, it must maintain high interest rates, which will exacerbate the risk of economic recession. The current U.S. economic situation has shown signs of stagflation. Wage levels have risen, but the growth rate is far outpaced by the increase in living costs such as rent and food, leading to a decline in residents' real purchasing power. Inflation data has eased but remains hovering above the 2% target, with strong stickiness in core inflation. The economy has not completely collapsed, but various indicators show fragility, and the market generally expects a recession to arrive soon. Stagflation deals a double blow to both businesses and consumers. Businesses face pressures of rising raw material costs, financing costs, and labor costs. While consumer demand is weak, leading to continuous compression of profit margins, consumers are trapped in a predicament of working hard but not earning more, struggling to improve their living standards despite increased labor input. In the long run, this will lead to a collapse in consumer confidence and a further decline in corporate investment willingness. This boiling frog in warm water type of economic state is more difficult to tackle than a simple recession, as the Federal Reserve's policy tools are almost ineffective. The market lacks a clear direction for recovery, and various assets will face sustained pressure, potentially leading the economy into a long-term stagnation. The analysis focuses on 6 major core assets: stocks, cryptocurrencies, the housing market, the commercial real estate market, gold and silver, and bonds. These assets are chosen as the core of the analysis because they cover the main areas of the U.S. capital market and are closely related to the macroeconomic cycle, interest rate policies, and market sentiment. Their performance can fully reflect the asset allocation logic under different economic environments. As core targets of the capital market, stocks are directly linked to corporate profitability and market liquidity, serving as a barometer of economic prosperity. Cryptocurrencies, as high-risk and highly sensitive assets, their price fluctuations often lead the traditional stock market, intuitively reflecting changes in market risk appetite. The housing market and commercial real estate market are important components of the U.S. real economy. The former is related to residents' asset allocation and consumption capacity, while the latter is closely tied to corporate operations and the job market, both being highly sensitive to interest rate policies. Gold and silver, as traditional safe haven assets, their core value lies in hedging against inflation and uncertainty, acting as a safe haven during economic turmoil. Bonds are directly linked to the Federal Reserve's interest rate policies. Changes in interest rates will directly affect bond prices, and the performance of the bond market can also reflect market expectations for economic growth and inflation. Behind the selection of these 6 major assets is a summary of laws based on historical cycles. The original text mentions that predicting the performance of various assets under different economic paths is much easier because history has given us many answers. Looking back at the U.S. economic cycles over the past few decades, whether the stagflation of the 1970s, the 2008 financial crisis hard landing, or the slow recovery after 2010 quasi-soft landing, these 6 major assets have shown clear upward and downward trends. For example, gold and silver performed prominently during stagflation. Stocks and real estate presented bottom-hunting opportunities after a hard landing, and bonds and leading technology stocks had more advantages in a soft landing environment. In addition, these 6 major assets cover different risk levels and return characteristics, ranging from low-risk bonds and gold to medium-risk real estate, and high-risk stocks and cryptocurrencies, which can meet the allocation needs of different investors and fully cover all stages of the economic cycle. In the current context of unclear 3 paths for the U.S. economy, analyzing the performance of these 6 major assets can help investors filter out market noise and find investment logic that can navigate the cycle, rather than blindly predicting economic trends. It should be emphasized that these 6 major assets do not exist in isolation but are interrelated and mutually influential. For example, changes in interest rates will simultaneously affect bond prices, the financing costs of the real estate market, and the valuation levels of stocks. Changes in market risk appetite will act on stocks and cryptocurrencies simultaneously. Inflation expectations will link the performance of gold and silver with bonds. Therefore, the core significance of analyzing these 6 major assets lies not only in understanding the upward and downward laws of individual assets but also in grasping the interrelationships between assets to construct a diversified investment portfolio, achieving the goal of profiting regardless of the economic environment. At the same time, these 6 major assets cover the main investment channels of U.S. residents and institutions, and their performance directly affects the appreciation or depreciation of overall wealth. Therefore, analyzing them has strong practical significance, providing clear decision-making references for both ordinary investors and professional investment institutions. In a soft landing environment, although the economy can stabilize, interest rates remain relatively high. This combination of high interest rates plus stable growth directly determines the differentiated performance of the 6 major assets. The stock market as a whole shows a positive trend, but it is by no means a bull market. The index may climb slowly, but most people will have a familiar feeling of not making money themselves. This is because although the economy has stabilized, interest rates are still high. So capital will be more concentrated in a small number of companies with the strongest profitability and highest certainty. Especially leading technology, AI, and chip companies such as Microsoft, Meta, Google, and Amazon. AI-related sectors are also likely to perform well. The risk here is that in a soft landing, interest rates will fall slowly, and the current valuations of AI companies are already high, so there will be no sharp increase. Instead, a valuation digestion period is needed. Cryptocurrencies should perform well because risk appetite has returned. Cryptocurrencies are more sensitive than stocks every time and will rise faster in this economic environment. The response of the housing market will be much slower because housing prices did not fall earlier even in a soft landing. Housing prices will not surge. Buyers will continue to be constrained by affordability. Those who want to buy cannot afford it, and those who want to sell struggle to do so. Although housing demand will recover and trading volume will gradually pick up, this stagnant state will persist for a long time before prices rise slowly. The commercial real estate market will experience obvious differentiation. Assets with stable cash flow will become stronger, while those that were already struggling will not be rescued by a soft landing and will continue to decline. This will present some excellent opportunities for undervalued assets, which will be accurately seized by patient hunters waiting on the sidelines. Essentially, as long as we are in a sustained high interest rate environment where money is expensive, investors are more willing to pay for assets with stable cash flow assets that can steadily make money even in a high interest rate environment. This has also been the focus of our company's asset purchases in recent years. In a soft landing environment, gold and silver will not surge again. Instead, they are more likely to trade sideways and able to rise significantly nor to fall. This is because risky assets start to perform better and market confidence improves. Finally, bonds prefer a soft landing environment because bonds fear 2 things most: economic collapse and sharp interest rate hikes. In a soft landing, neither will happen. Interest rates will fall slowly, and the economy will not collapse, so bond prices will rise gradually. In a hard landing scenario, where we enter an economic recession, though it sounds terrifying, as mentioned earlier, there will be greater opportunities for a turnaround. Stocks will definitely experience a sharp correction first, and the decline will be significant, especially high valuation growth stocks that are not profitable now and rely solely on storytelling. However, a hard landing is often the starting point of the next bull market, because once the Federal Reserve launches sharp interest rate cuts, liquidity will return, and stock prices will rebound rapidly. This also means that many high-valuation AI sectors will experience a discounted market, allowing patient hunters to seize the opportunity to buy at very low prices. In an economic recession, cryptocurrencies will also fall along with stocks, but their rebound is usually faster than that of stocks. Similarly, this process of collapse and rise will provide bottom hunting opportunities for hunters waiting on the sidelines. Then there is real estate. The characteristic of real estate is that it responds slowly to the economy but very quickly to interest rates. A hard landing itself is not a good thing, but its real positive impact comes from interest rate cuts and the recovery of liquidity after the recession. Therefore, in the medium and long term, a hard landing is a real great opportunity for real estate. Initially, trading volume may decline, and prices will not collapse that fast. But as long as the Federal Reserve launches loose policies with fast and sharp interest rate cuts, borrowing costs will drop significantly. This is a major positive for both the housing market and the commercial real estate market, and the market will recover rapidly. Those who bought at the bottom when prices were very low and already hold assets will start to reap the rewards. Next, gold and silver. By nature, gold and silver have reason to surge as long as there is recession panic. But it is important not to misunderstand. They will not rise as soon as an economic crisis occurs. On the contrary, they will fall. Because when a crisis first breaks out, the market panics, liquidity is tight, And many investors will sell everything to exchange for cash, including gold in their hands. So gold will also be sold off, leading to a price drop. But as the recession progresses, the Federal Reserve intervenes with rapid interest rate cuts, entering a loose cycle, and gold will start to soar. Finally, bonds love interest rate cuts the most. As long as the Federal Reserve starts aggressive interest rate cuts after a crisis, bond prices will rise. In a stagflation environment, the most difficult and painful path among the three, stagflation makes the stock market the hardest environment to make money. Why? Because the stock market fears two things most. First, compressed corporate profits. Second, high interest rates and low valuations. Under stagflation, both happen simultaneously. Therefore, the stock market as a whole will show high volatility and oscillation unable to rise, yet with high risks. This is the most torturous market trend and one where it is difficult to make money. In this market environment, two types of companies are more favored. First, large companies with pricing power that can successfully pass on costs to consumers. Second, traditional or essential consumer goods, such as food and medical care. Meanwhile, technology and AI growth stocks those that need to tell stories about the future are unpopular in stagflation. Then there are cryptocurrencies. Cryptocurrencies thrive on liquidity and market sentiment expectations, or whether you have a story to tell. In a stagflation environment, the Federal Reserve dare not cut interest rates. Liquidity is poor, and the market is pessimistic about the future, easily spooked by the slightest sign of trouble. As a result, cryptocurrencies are prone to volatile swings with no clear direction. Similar to the stock market, they experience high volatility and high risks. In a stagflation environment, housing prices will hold steady, but trading will freeze, no transactions, much like the current situation. Because interest rates are still high, mortgages are expensive. Buyers cannot afford them, and sellers are unwilling to sell at a loss. So housing prices will not fall, and inventory remains low. Commercial real estate will see a serious polarization, because the essence of stagflation is high costs without interest rate cuts. Bad assets with broken cash flow will continue to blow up, deteriorate, and accelerate their decline. But high-quality assets with strong and stable cash flow will be chased by large capital, maintaining steady growth. Because during stagflation, the market fears risk the most, and safe haven funds will automatically flow to stable, resilient assets with cash flow. The divide between good and bad assets will become very pronounced. In a stagflation environment, gold and silver are the strongest performers. Because gold loves two things most: inflation and uncertainty. Stagflation is the perfect combination of the two. So stagflation is the most ideal bull market environment for gold, with an excellent upward trend. As long as CPI does not drop to the target, interest rates do not cut, geopolitical tensions persist, and US debt pressure remains, gold will keep rising. This is why gold and silver are performing so strongly now, because we have already one foot in stagflation. Finally, bonds. Bonds are the most miserable assets in a stagflation environment. Because bonds hate nothing more than high interest rates and high inflation, and both are at their peak in stagflation. Especially long-term bonds, which suffer the most. So now we have covered the three economic environments. While we cannot predict which path the US economy will take, we can summarize that regardless of whether a soft landing, hard landing, or stagflation occurs in the long run, the assets that perform the strongest are: first, physical assets in real estate with strong cash flow and stable operations. If they can be bought at a low price, it is a steal. This is the focus of our company this year and next. It should be emphasized that I am not referring to all real estate, but physical assets with very strong cash flow, extremely stable tenants, and a healthy structural design, certainly not assets with structurally damaged fundamentals like office buildings. Such opportunities are actually extremely scarce and hard to find in today's real estate market. After all, cash flow needs to be this strong and stable. Second, AI sector stocks that are discounted after sharp oscillations. Many promising stocks can be selected. After all, technology, especially AI, remains the main growth driver for the next decade, a field where large capital will continue to invest. As long as you can identify undervalued assets misunderstood by the market, those are our opportunities. Third, it is evident that gold and silver have shown consistent stability. Because gold becomes stronger whenever it encounters factors like inflation, uncertainty, economic instability, or interest rate volatility. Our current economic environment is highly unstable and full of uncertainties, so gold keeps rising. Moreover, gold is now receiving more attention from central banks around the world than ever before, becoming the most trusted reserve asset for various countries, driving demand even higher. In addition to the above three types of assets that perform strongest in the long run, I believe it is also necessary to hold more cash now to add a safety buffer. Diversify risks, and be ready to seize real good opportunities when they arise. Having bullets on hand will ensure you don't miss out. In short, today's market is full of uncertainty. We cannot predict the direction of the market, but we have clarified the overall trend. This allows us to focus on the areas we need to pay attention to and select the right assets to invest in. If you are an accredited investor and want to see what opportunities prompt us to act, scan the QR code or click the link below the video to join my next live broadcast. There is a lot of cash in the market now, just like us, looking for real opportunities. Most people usually wait for clear signals before daring to act, but in reality, by the time we start hearing the media say the market is recovering, you'd better already hold assets. That's what makes you a winner. Because prices would have already rebounded long before that.